Tri-City Center at the 10 and 210 freeways. We're the trifecta of talk in Southern California. KCAA 102.3 FM Riverside, 106.5 FM Redlands, and the Legacy 1050 AM Loma Linda, San Bernardino.
You're listening to an encore presentation of this program, KCAA, the Inland Talk Express.
Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929 is the telephone number. If you pick up the phone and give us a call, we'd like to talk to you about your mortgage. We'd like to figure out if we can help you either by reducing the rate you currently have, which, by the way, if you haven't refinanced by now, and rates have been as low as 2.75% years ago, and now they're almost at 5%. If you haven't refied out of that 6 to 7% mortgage by now, well, you probably won't. But if you are one of these people who have been procrastinating, or you've been under a rock, or you've been sleeping in the ocean for the last 6 or 7 years, there is time, and there are rates available right now, especially on a 7-1 product, a 5-1 product. These are ARM products, but you certainly can get interest rates lower than you have if you are in the 6-7% range. Now, why do I say that? Because I know that there are some people out there who have had adjustable rates who are just now adjusting. Those people who've had 10-1 ARMs 10 years ago got a adjustable rate mortgage product that is now coming due and is now going to be recast or reset. You probably want to work your way into a 30-year fixed rate product, and you want to be able to get into something below 5%. You can still do that, and there are loan programs out there for those people, obviously, who are working, who can prove that they can repay their loan, who have pretty good credit score, and you can get yourself a pretty good rate. So I know if you're out there and you're thinking about it, the best thing to do is to pick up the phone and find out. Talk to me, talk to one of my loan officers, and by the way, if you want to find out Malibu Funding, the great loan officers that work for that company, go to their website, www.malibufunding.net. That's the website that you can go to figure out if you want to work with one of these terrific people. A lot of the loan officers on that site have pictures, bios, or certainly ways that you can get a hold of them and be able to contact them, especially with your mortgage questions, your mortgage problems. If you have a scenario, something that you're trying to do but you're not quite sure if you can do it, call them, call me. Anybody in the company can certainly help you figure out if in fact this is something that you can do. I know that there are many people out there looking for answers for long-term financial security. You can go into the stock market. We are a country that likes to gamble, so stock market itself, sure, I understand it. But if you're looking at a 26,000 Dow Jones Industrial Average today, and you're a little bit nervous about that, and you want to put it into some hard asset, real estate's the way to go. As I was talking, or will be talking later on in the show, there are a couple properties around the Los Angeles area that I saw just recently, which I was very, very surprised at. Duplexes for $750,000. Mixed use units, i.e. you can live and work in the same unit for about that I think it was $650,000, and it was in the valley, in the San Fernando Valley. Now, I know the show is in San Bernardino, Riverside counties. I want to say hi to everybody over there at KCAA and KMET, as well as our friends up in Northern California at K Tahoe. Yes, there are opportunities in the real estate market that you can get into, that you want to be able to invest your time, your energy, your spirit into finding something that will work for you long term, so that you maybe can make some money off your property, or maybe live in one half and rent out the other half, or use your business in one half. There are some loans, and again, later on in the show, we'll talk about different loan programs. Got a great show, 3 different account executives from different lenders to be able to try to help you with different products in the market. They will give you an understanding of what's going on, about the feeling in the market. I know interest rates are rising. It is not simple to try to figure out if you can afford something. A lot of people are having more than one person on a loan. There's a lot of less than 20% down payment programs, but you're going to have to come up with mortgage insurance. Yes, all of these things are factors in whether you can afford a mortgage. If you can't afford a mortgage, that's great, but there's only one way to find out, and I know if you're feeling like, I don't know, should I get in there, or should I call the guy up? You should. Either call me, call one of my great loan officers who work at Malibu Funding, who, by the way, sponsors the show. Thank you very much to these fine folks. But if you need to know, and I know you need to know, because in the mortgage market, there are many programs that you might not know about it. There are programs for non-citizens. There are programs for bad credit scores. There are programs for down payment assistance. There are certainly programs for people with 800 FICO scores, 20% down, and want to have the lowest rate possible. Now, all of these, by the way, jumbo rates. So let's get into this for 1 second. Reading an article recently about jumbos. Now, jumbos are anything over $600 and let's say $70,000. It's $667, $79, something like that, in terms of what they are with the agencies and with government loans. But jumbo loans have traditionally been harder to get than necessarily a standard, loan that would be purchased by Fannie Mae, Freddie Mac, or by Ginnie Mae or Sallie Mae. But the jumbo loans themselves, because they yield a much higher return for the lender, are actually getting easier to get. Lower documentation. If you have certain criteria of a loan, even super jumbo loans, let's say you have a loan need of over $1 million, can you get that loan? The answer is yes. There's a lot of people in the jumbo sector that you wouldn't realize actually want to lend you that type of money because of the fact that there's more money to be made. There are fewer loans in the marketplace, and I keep harping on this each and every week. This is a competitive environment, more so than normally. You're going to see mergers and acquisitions in the lending space. You're going to see larger lenders getting out of origination of mortgages. Both of these things combined mean that the opportunity for someone who needs a loan to shop around and get a best deal, the better deal, or to be able to borrow more money is greater today than it has been. Yes, the documentation on a lot of loans is severe. I understand that. But on non-QM products, on jumbo loans, the documentation is actually less. For a jumbo loan of $1 million, if you come in with $100,000, $150,000, sounds like a lot of money, but it's really only 10 to 15% of the loan value. And you're borrowing $950 to $975 to $1 million on a $1.2 million property, let's say. Those documentation on that particular loan is less than it would be if you had 3 borrowers on a $450,000 FHA loan. I know it sounds crazy, but it is true. People who are in the space to lend a lot of money want to do so. There's pressures on our industry. If you can make more money on a $1 million loan than you can on 3 $350,000 FHA loans, and there's less risk because there's more money into the larger loan, a company would be crazy not to want to do that type of loan. That's what we're saying when we say it's easier to borrow that type of money. You only need one investor for a large loan like that. You might need 3 investors for those smaller FHA loans, and by the way, the FHA loan default rate is higher than the jumbo default rate. Yes, I know it doesn't make sense, but if you think about the fact that if I'm going to buy a $1.2 million property and I'm going to put $200,000 down and the market is ascending in the value by which my property today is going to be worth more tomorrow, the person who is at risk here is the person borrowing the money, because nobody wants to give up the $200,000 they've already got into the property, and nobody wants to give away future equity in the property. So if you're one of those people and you're thinking about looking for that type of loan, shop around. There's a lot of lenders who want that type of loan because they know the security in that loan is your desire never to let that property go. 1, you got $200,000 in it, and 2, next year it's going to be worth another 5-6%. So $260,000 into a property on $1.2 million that's now worth $1.260 million, yes, you probably are going to repay that loan. You're probably going to be an excellent risk as opposed to those people who are trying to get in for 96.5% loan. those people are more of a risk. And as I said earlier, there's more default on FHA loans than there are on jumbo loans. Anyway, I'm Jeff Barton. I'm your voice in the mortgage industry. I'm really happy you're going to stick with us for the show today. Got a lot of great people on the show, and thank you very much, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome, everybody. I'm Jeff Barton, your voice in the mortgage industry, 888-713-2929. That's our telephone number. Pick up the phone and give us a call. We talk mortgages on the show. We talk all those boring, mundane, detailed-oriented things that, you know what, you're going to need if you want to get a house. And I think we can make it exciting, listenable, and something that you're going to be able to use right away. A lot of things that we try to do on the show, that we do on the show, and that we're going to do on the show really benefit those people who are looking for a home. Somebody who's trying to figure out whether the low inventory, rising interest rates, and what they can do about it. What we try to do and what we're going to do this week is bring on 3 different people who have solutions, or lenders, people who are in the industry, not necessarily me over here at Malibu Funding. Want to say thank you to Malibu for sponsoring the show, as well as the people at KCAA, KMET, and K-Tahoe for putting the show on the air and into their listening audience's ears each and every weekend. First up on the show, and I really appreciate Ryan to come back on the show, Ron Mercier from the lender. Ryan, how are you?
I'm doing well. How are you?
I'm great. Thank you very much, and thanks for coming on the show.
Yeah, you got it.
Okay, so you hear what we're trying to do here today, which is basically help people who are really challenged by both rising interest rates and low inventory, which means they're probably going to be searching hard and fast, and maybe they don't have the perfect cookie-cutter loan that they can go get with somebody else. What are you guys doing in order to help these kind of borrowers?
Sure. Well, we have a wide range of products. I mean, the government business, we're going down to 500 FICO scores for some credit-challenged borrowers,
okay.
Common sense underwriting approach.
Now, when you say government, you mean FHA primarily,
correct.
right? Right,
FHA
okay.
and VA as well.
Okay, great. And so in those programs, going down to a lower FICO score is kind of outside the norm, right? Don't most companies do 620 FICO scores for FHA?
Correct, 620. A few go down to 580, but there's not many out there going down to 500. So that is kind of a niche market that we have, and we're doing a handful of business on a monthly basis, more than a handful.
Okay, excellent. Now, in trying to help people get into homes, I know it's not easy, but what your company has done, and you've been doing it with Malibu Funding, by the way, and we really appreciate the ability by which to go to you guys for solutions in when we have either the credit challenged person, but some of the other programs. Why don't you give us an idea of what are some of the other programs that you're using to help these type of borrowers?
Sure. We've rolled out some non-QM type products. Bank statement loans. Mm-hmm. We have what we call is our restart program for people that have had even some mortgage lates, a hiccup, and even in the last 12 months or last 24 months, with a little bit lower FICO scores, we still can go up to 80-90% LTV with these non-QM products. Bank statements as well for those self-employed borrowers who probably write off bunch of stuff on their taxes, and we know they make money. They just take advantage of writing off the income on their tax return. So we can help them with the bank statement stuff as well. Now,
when we get into these non-QM products, and for those of you out there in the listening audience, non-QM means there's qualified mortgages, which get sold to Fannie Mae and Freddie Mac, and then non-qualified mortgages that either get housed by the lender that is actually doing the loan or get sold off in some portfolio. What do you guys do with the loans? Do you keep them yourselves?
We have a relationship with an investor that we sell them to that has an appetite for that business. We are fully delegated, so we do all the underwriting here. It doesn't have to go to anywhere else to do a re-underwrite. We do a second sign on them. Just have another set of eyes just to make sure our T's are crossed and our I's are dotted. But it's all done here in-house, and we have an investor that is ready and ready to buy that business from us.
Now, in that, obviously liquidation in any kind of market is really, really important. But when you're dealing with the non-QM space, I noticed that a lot of different lenders, a lot of different banks are expanding their portfolio. Does this mean that the secondary market is opening up a little bit more than what we'd seen in the past, i.e. it's not just government 90%, we might get more of a 50-50 flow in the future?
Yeah, I've seen a big increase in scenarios or questions regarding the non-QM type stuff. I've even seen something come across my desk where a lender was doing a quasi-stated program.
I saw that too. Yeah.
You would just need a P&L, and it's a borrower-generated P&L. It's not audited. So to answer your question, yes, I believe it is opening up. With the rising rate environment, I think to keep people getting in homes and keep the purchases going, they have to open up the product line a little bit.
Okay, so a couple things about that. Obviously, I have been hearing the same thing, been approached by a couple of people, and actually lost a loan officer who went to a company that was doing stated loans, quote-unquote stated loans.
Right.
Now, in the old days, if we did stated loans, no problem. But ever since, obviously, 2008, the crash, we have been really reluctant to get into these spaces. Do you think the lack of mortgage loans in general is causing or forcing lenders to open up to different kinds of loans than they might not have approached 2 or 3 years ago?
Yeah, I would definitely agree with that.
Right.
With the rates going up, the rate and term refinances are basically gone.
Yep.
You have cash out business where borrowers are consolidating debt. We're still doing those. But yeah, I mean, with the rates on the rise and the values of homes going up, the mortgages are slowing down. So I think they to keep the lights on, the doors open, and
yeah, right.
keep people in their homes, we got to be able to open up the product line. And they're not 500 FICO score stated 80-20 type stuff back in the day. They're still qualified borrowers, with a hiccup one way or another. So,
well, how much in stated like type of products that may be coming down the pipeline? And I know there's a vast majority, not majority, but a good amount of people in my listening audience who are not traditional borrowers, who are looking for more of a stated loan product, who would be willing to put down 20-30%. Is that what it's going to take in order to secure it, or do you see even less of a down payment for these type of stated loans in the future?
No, I believe it's going to be a substantial 30% down type program, right. Maybe 20% if there's an aggressive lender out there, but I don't think anybody's going to really get into that space, or at least be the first lender to get into that space without a heavy down payment, having the borrower have some legitimate skin in the game. Right,
and I think what we're looking for, obviously, with rates going up, and that's another thing, where do you see rates heading in the next 6 months till 2019?
Yeah, I mean, I can't see them. I can't see them dropping
right.
A substantial amount. I can only see them going up. So what I've been telling my brokers and loan officers that I work with, if the deal works today, lock it. Don't wait. Even do a 45-day lock if you have to, because people that gamble on this type of market normally lose. So,
yeah. I agree. I think that, I mean, if you're looking at standard rates now, almost at 5%, right? Isn't that where
right.
you guys are, pricing them? So anything, and I could see 5.5 by the end of the year easily with 2 more rate hikes at the Fed.
Sure. I would agree with that.
Now, you're predominantly purchase business, I assume, right?
Correct, yes.
Okay, and in the purchase business, are you getting them from first-time home buyers, or are you getting them from people who are stepping up? I mean, do you see that type of market existing now that obviously...
Yeah, I'm seeing where borrowers are trying to take advantage of the values. Their homes are increased, and they're surprised at what their homes are worth, so they're like, let's sell, and, it's time maybe to upgrade for us as well. So
right.
I'm seeing repeat buyers. I'm seeing first-time home buyers as well, but not as much in a rate increasing environment. So it's a lot of repeat buyers, but with our service levels as well, turning them quickly, it helps get those borrowers in there and off the streets.
Okay, a couple last questions. One, do you think that borrowers feel pressure to make up income documentation in order to get a loan just because they don't want to get frozen out of the market? I read Fannie Mae updates. I get a lot of bulletins from investors looking at borrowers a little bit more hard nowadays. I just know that when rates rise and inventory shrinks, you get a lot of people to get nervous about never being able to get into the market. Do you find that that's an issue with you guys?
Yeah, I've seen that. I mean, we haven't seen a large increase of people trying to make up income, but we're seeing multiple borrowers, or we're seeing with the FHA stuff, we're seeing a non-occupant co-mortgager, a mom or dad, that's brother, sister, that's helping them qualify.
Right.
But yeah, I mean, you're seeing sometimes 3 or 4 borrowers on a loan right now.
Yeah, I think that that's quite typical in a lot of households, just so that they can qualify on the income.
Sure.
Hey, listen, could you shout out your phone number in case somebody wants to get a hold of you and talk a little bit about mortgages?
Yes, 714-273-6637 is my direct line. Call me anytime.
Okay, Ryan. Hey, thanks very much for coming on the show. This is Brian Maracia from The Lender. Terrific. Thanks very much for the information.
You got it, guys. You have a great show. I'll talk to you later.
And we'll talk to you as well. And I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry, 888-713-2929. That's our telephone number over here. If you pick up the phone and give us a call, you can get on air right now. Talk to us about your mortgage situation. Maybe you've got some problems. Maybe you've got a solution or two for other people out there who are looking at a similar situation. Maybe you have a low down payment, credit scores aren't as what they want to be, or, you know, there's all kinds of things that can go on within the mortgage process that you either have experienced, or maybe you need some information because you just don't know what to do. We try to bring that to you each and every week. And if you'd like to reach us via email, info@malibufunding.net, that's our email account. If you want to see me on Twitter, @Jeff6493, that's my Twitter handle. I don't tweet a huge amount, but I do tweet out enough so that I have a presence, and I want to bring one of the people to the show. Once again, April Lopez from Nations Direct, who has been on the show several times. And April, first off, how are you?
I'm doing great, Jeff. How are you today?
I'm just great. Are you a tweeter? Do you live in the Twitter sphere, or are you one of these people who has got other sort of avenues of communication?
I don't tweet. I definitely use Instagram and my Facebook for my social media advertising.
Okay, very good. So now, your children, are they tweeters, whatever they call them?
Absolutely. You know, the millennials, that social media, they're retweeting a tweet.
Yep.
So they are definitely involved.
Well, one of the things that I wanted to ask you about, and the reason I bring it up, is because there's so many ways to reach people nowadays, and obviously in a climate like we have, where we've got rising interest rates, low inventory, the immediacy of any kind of a response or information to consumers is extremely important. And so we have to become, or I've become, adept at really reaching people in any number of ways. So for you, who is in a very similar position, if you were to reach a certain client, albeit under 40 years old, under 30 years old, over 50 years old, there's different ways to do that, right?
Absolutely, absolutely. Most of the ones that are the baby boomers, of course, they're not interested at all, even with emails. They want you to come to their office or to their home and correspond with them face-to-face. But definitely, you know, even today's brokers, they want everything, which I love, via email or text message, because they're getting it instantaneously and can respond and appreciate getting their answers quickly that way.
Now, if you have a rate increase over at Nations and you want your borrowers or your brokers to know it right away, how do you get that information? Because obviously we're in a volatile time with interest rates, mostly on the negative side. How are you passing that information on quickly to the broker so they can tell their clients?
We're doing it via email, and so, you know, it's unfortunate that, you know, they're only getting to know once the deterioration happens.
Right.
If they follow the market any, or some lenders act faster than others, they're instantly calling saying, hey, so-and-so deteriorated, what does it look like for you? And chances are, you know, depending how we hedged in the morning, you're looking at a deterioration as well.
Okay, so in a rate-conscious environment, which I think we're in all the time, but certainly now it looks like we're going to get 2 more rate hikes from the Fed. What are you suggesting to your brokers, especially those that are looking for multiple borrowers on their 1003s, in terms of where we're heading in the marketplace?
Well, because everyone is finally accepting the rates have increased.
Right.
From a refi standpoint, we're really only looking at the cash out refi. So we're looking at borrowers who want to take some cash out to have some liquid cash and or do some home improvement. And then on the purchase side, really what you have to do is really kind of sad. The inventory is still very low, in which case I'm seeing overpriced multiple offers, anywhere from 10 to 12 over-ask price offers on every property that's under $1.5 million.
Really?
Because that market is really aggressive. And again, you're finding half of those offers are all cash deals, or they're waiving contingencies so they can appear to have a stronger offer.
Right. Okay, now I know you deal with a lot of realtors, and as a lender, as somebody who's in the business of looking at multiple contracts when they come in the door, how many of these real estate contracts which are promising either all cash or no contingencies, how many of them actually fulfill that particular end of the bargain, meaning that once they get in, does it even matter at that point because you're kind of stuck with these people?
Well, that's a good question to ask, because what we find, if they're all cash, usually there's never a problem.
Right.
What I have seen of recent is, either the escrow gets extended because your time frame from day of acceptance to the 21 days, whether it's loan contingency, appraisal contingency, that loan agent has from 0 to 21 days to perform. So if that loan agent is not well-versed or seasoned and they haven't already gathered up everything, because the minute that offer is accepted, all they should be doing is plugging in an address,
right,
getting escrow fees, and submitting to the lender. But it's very crucial timing. So what happens is I see that either, I find that most of them are performing, I would say 6 months ago, 60% of all offers were falling out, and actually backup offers were being accepted. Now, I think now it's changed a little bit, fast forward, but they have pretty much been coming through with maybe a little delay with the loan, and then on top of that, you're seeing about 60% of the business is contingent sales or contingent buys.
I see.
So that means an offer is, the seller still has to look for his or her home of choice. So the buyer who puts in the offer, who finally gets accepted, has to wait until that home of choice is identified.
Well, that seems problematic to me. Obviously, with the chain of events that needs to take place, it puts everybody under such pressure. And do you see pressure in the marketplace to perform, not only from a lender's side, but obviously, as you're describing it, from a buyer and a seller, and also that because of the lack of inventory, there's just pressure on everybody more so than it would be in a normal market?
Yes, I think that the buyers, starting with them, they get a little discouraged because they're putting in offer after offer and they're getting overbidded, or they're just losing in general. And so I find that, after a few, they decide to change their mind and then determine, do I extend my lease because I'm leasing now for another year? It's very challenging, and I think all of that, stems from, education, knowing, how, if you love it, and this is what I tell the buyers, if you absolutely know this is the house for you, you need to be ready to go, to be aggressive. There's no discounts anymore, Jeff. So these buyers who came from 2009 to 2012, and they think they can put in an under market.
Right, I agree. Okay, they're wasting time. Yeah, I think that whole wasting time thing is just that. I mean, you cannot waste the time of a seller. They'll just take the next offer. Okay, we've got about 3 minutes left. Give me your idea or your solution for that problem buyer, or what's a product that seems to be moving really well right now over at Nations. And again, this is April Lopez for Nations Direct Mortgage.
Well, I would say that right now what's been really nice is the private mortgage insurance companies have recognized that their rates are increasing, so they've actually offered up discounts. So MGIC, a private mortgage company, as of July 9th, they've not only reduced the monthly mortgage insurance rates, but they also have given discounts on multiple buyers. So if there's more than one buyer, they're getting an extra little bit off of their mortgage insurance to give them a little bit more buying power since the rates are increasing. So I would say that at less than 20% down, the mortgage insurance companies have gotten really aggressive to give lower rates so that they can get more buyers into homes.
So in doing that, obviously, there's going to be less costs, less closing costs, and less monthly costs into the buyers, right? And this is on all loans?
This is on all Fannie and Freddie loans
right.
that are less than 20% down payment. And
this has been... Yeah, we're losing you a little bit between towers. This is April Lopez from Nations Direct Mortgage. We thought we might have a little issue with her. If you can still hear me, April, just a couple less things. One, appreciate you coming on the show today and obviously filling time for me, answering questions about what's going on over at Nations, how you're helping in this type of market. And two, where do you see the real estate market headed?
Well, I feel that we're going to be strong for a good year. I mean, even though
right.
rates are increasing, I think that in 19, middle to end of 19 is where you might see some stabilization or some little bit of, I would say a little dip in values because it's been so, we've had heightened pricing, this whole year in
right.
value. So I would say we've got another really good, strong year, and I would think that, have these buyers take advantage of some down payment assistance programs that are offered and lower down payments so that they can get into some homes that are affordable.
Hey, April, could you shout out your phone number for those that would like to be able to get in touch with you about some of these things that you're talking about?
Absolutely. April Lopez at Nations Direct Mortgage, area code 818-398-1272.
April, thank you very much for once again coming on the show. I always enjoy it and always enjoy talking to you. Thanks a lot.
Likewise. Have a great day, Jeff.
You too, April. And that's April Lopez from Nations Direct Mortgage. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929 is our telephone number. Pick up the phone and give us a call. We talk mortgages, we talk real estate, we talk all things having to do with real estate, which really means, you're either looking at location or schools, or maybe you're looking at a second home, things that you really need to make good in your life. You need the mortgage in order to be able to satisfy whatever the housing needs are in your area. And I know right now it's very difficult to find a house of your dreams, but there are certainly product out there that you will be able to afford. I came across 2 or 3 properties today, and granted, it's in Los Angeles, so maybe that's not where you want to live, but they look like pretty good deals, and I was surprised by that. Under $700,000 for a duplex over off of Adams. There was another one out in the East LA area, very similar type of property, looked really good. It was a duplex, something that you could get into, maybe live in one, rent out the other. Anyway, there are solutions out there for your housing needs. I want to try to help you do that. One of the guys that can help us do that from Lone Stream is Tomas Trujillo, and I really appreciate it. Tomas, thanks for coming on the show.
Oh, Jeff, anything for you.
Thank you very much. That's excellent. Hey, listen, what are we doing over at Lone Stream to try to help these people in a rising interest rate climate with the inventory so low?
Well, these days, there's really not that one lender anymore who has the best rates out there because it's all the same thing, so it's not even
right.
that anymore. It's more of what can you do for me? How can you help me? I just went to Wells Fargo, and they said they couldn't help me. I went to Chase, and they can't help me either.
Right.
Well, you have a guy who's working with you who just is tearing it up right now. He's going out there, and he's finding those guys who just can't get a loan. They don't have the down payment anymore. So he'll do a Cal HAPA. They just switched new jobs, so he'll do a VOE program. They don't have their Social Security card yet. So what's he doing? He's doing the I-10 program.
And all of these are programs that you have over at Lone Stream?
Absolutely, absolutely. The newest ones were the I-10.
Right.
That is helping that one borrower who's here but just can't get all his paperwork in order. It's taking forever, so we can do a loan for him now.
Okay, give us an idea, a quick rundown of some of the documentation you're going to need for this I-10 program. And what is an I-10 anyway?
Well, if you don't have your social yet, but you're still here, you get your identification number, so you can file your taxes. You can open credit trades on that. You can go to smaller companies who will give you credit, like maybe La Curazao, Davis Jewelry,
right,
those kind of places.
So, in fact, then you would build a credit history without having a Social Security number, and then you would use what in order to get a loan?
You would use that number. So instead of a social, you would use the I-10 number that's given to you by the government. They give you a letter saying, okay, here's your number, use that number. So we'll take that. You can purchase a home. You can do a rate and term refi. You can cash out a home. You can buy a home up to $1.5 million using your I-10 number.
Okay.
Non-permanent resident aliens.
Okay, so these particular numbers are applied for through the government, no, state government, federal government?
Yes, sir.
Okay.
Absolutely.
Okay, so, and when you grab these numbers, obviously using them to get a loan is really a boon for a lot of people who are here, who have been here, who have family here, who might not yet be a citizen, but who certainly want to buy in on the American dream. And we have a lot of people out there in our audience who would be excited to be able to take advantage of this. What's the application process like? How, as you said, up to $1.5 million, what are the rates like? What are the costs like? Give us some idea.
It is the same as our regular NANQ. We'll go up to 85 LTV. The cost is a flat cost. It's not a hard money loan. It's a regular, real loan.
Right.
So we can go like to 85 LTV. If you have better credit, the better FICO, you get the better rates. If you have the worst FICO, we'll go all the way down to like a 620 FICO on that. So I mean, we can work with you. We'll get you in there, regardless of your status.
Okay,
It's
so
a big thing to say these days.
yeah, it's a big deal. And in California, obviously, solutions that we look for to help people, because our market's different from a lot of other markets in that we have a lot of mixed families. I.e., when I say that, I mean some of the people here are not necessarily 100% documented, and some are. So you've got mixed families, families who obviously want to be able to take part in the American dream, and this is one of the ways they can do it, right?
Oh, absolutely. Owner-occupied, non-owner-occupied, you're fine. 1 to 4 units, townhomes, PUDs, condos. You want it, find it, we'll help you finance it.
Do you think that this move towards the non-QM, towards these type of programs, is pushing the market into a more private sector market rather than the GSEs?
I do. I really do. I think that the other market is just it's just too hard. There's too many people out there who are trying to buy, who want to buy, that just can't. It's so regulated. So this just opens it up a little more, gives you a little more freedom to do what you need to do.
Yeah, I think that's true, too. And again, in California, some other states as well, we have a great need and obviously a great need for housing. Do you see the real estate market catching a break, i.e. either more housing coming or prices at least stabilizing, if not going down?
I don't think they'll be going down too much, maybe stabilizing a little more, but I see a lot of construction going around. Where I live in Santa Clarita, we have about close to 500,000 homes coming in within the next 2 years.
How many? 5,000?
500,000.
That's an incredible amount of homes. Where are they building?
Right behind Matthew Mountain, they're building, I think it's $50,000 home, 50,000 homes.
Right.
On the other side, they're building another 300,000. They're putting a luxury golf course. It's really booming out here.
You know, I love it out there. I've been there many times. It's got the same climate as a lot of our listening audience in San Bernardino and Riverside. And so you're saying that these are under construction and they'll be available in the market in the next couple of years?
They will be.
Oh,
absolutely.
No, that's excellent. I think what we need here, both locally and nationally, is more housing. Obviously, if we have a need for 1 million houses a year and we're only getting 800,000 into the marketplace, there's obviously a shortfall, and that's going to affect prices on existing homes. And I think the prices on existing homes have really risen. Well, I just looked at a statistic today that said that we're up about 6.5% from last year. Now, I don't know how many years in a row that you can do this, but this is about the third or fourth year in a row it's been been going up that much. I don't think it's sustainable. I'm a little worried about the economy overheating and then having an implosion of sorts. So obviously more housing would cool down the prices and give people more of an opportunity to get into the housing market, which is the stability that you really need, especially when it seems like everybody's working, right? What are you seeing in the employment in terms of the borrowers that are coming over to Loan Stream?
You know, I'm seeing a lot more people who yes, they're working, but they're not working traditionally. They're more self-employed now. They have other things going on. So, and with people like that, I can use my bank statement program.
Okay.
Or I can use my no-doc program for people who want to buy investment property. So it's not what it was a couple of years ago. It's not as traditional. It's really opening up.
Well, when it does open up, do you see any risk in that? I mean, for you guys, what are you doing with your loans, first of all? And then if there is any kind of risk, how are you mitigating the risk?
Well, everybody has mortgage insurance now. On these loans, you're going to have mortgage insurance all the way through.
I see.
No matter what LTV you're going to be at. So that's one thing. Other than that, you know what? We're looking at the borrower because you can never really know. We know that from the last turn time.
Right.
I think we're just looking a little better. We have a little more common sense, and I think I don't know if there's any way you can mitigate any kind of loss, but we're trying.
Well, in the insurance sector, are you finding that some of your insurance rates have gone down by some of the private mortgage insurance companies?
Absolutely. We're getting better rates from our vendors out there. So
right.
I think everybody has a good feeling for what they're doing right now.
Okay, very good. One last question. Where are you spending your summer vacation?
You kidding? I'm working.
You're too busy, right? I know that,
right.
you know, but we find a lot in Southern California that people from all over the country come here. They look to Southern California for a lot of recreation. I mean, obviously it's beautiful. The beaches are beautiful. The Inland Empire, even up where you are, obviously Magic Mountain. Do you see an effect, how tourism is affecting both your commute on a daily basis and the quality of life? As I was looking at the quality of life figures, Los Angeles, the surrounding areas and counties came in 50 out of 50 top cities.
Wow, that's really good. That's really, really good. Well, you know, I think with all the tourism that we do have, it's just more opportunities for people. Because people, they do the Airbnb.
Right.
Now we're even using that kind of income.
Well, explain that. How are you using that income? Are you just allowing it to be able to be used even though it's seasonal or once in a while?
Even though it's seasonal, once in a while, you have a contract, and we'll take that income.
Well, that's very good. So anybody out there is using this or any kind of short-term rental, you can now use that in order to qualify for a higher mortgage.
Absolutely, you can. Absolutely. Like you said, especially here in California. Who doesn't want to come here? The whole world wants to come here.
Yeah, no, you're absolutely right. Tomas, thank you. I'm up against the clock. I really appreciate you coming on once again to enlighten both the audience and give us the information that's really useful. Thanks.
Yes, sir.
Okay, thank you very much. And that's Tomas Trujillo from Loan Stream, and I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929. That's our telephone number. Pick up the phone and give us a call. We talk mortgages on the show. We talk real estate. We talk scarcity of product. Obviously, anybody out there looking for a home right now knows that. Yes, your block may have 2 or 3 homes available for sale, but can you afford it? You need to find somebody to tell you what you can afford legitimately. There are some ways that you can get into a property, perhaps that you need to add a borrower onto your particular loan application so that you can use that income additionally to be able to qualify for more on your mortgage. This is a way that you can be able to get into a property that, quite frankly, you might not be able to afford on your own. It doesn't have to be a family member. It can be somebody other than a family member. It used to be only family members, but they expanded that a couple of years ago. Let's see. Has anyone out there ever been in a situation where they need to do something but not necessarily have the ability to do it, i.e., you have to be able to get a job in order to get a loan, right? I mean, this is straightforward, easy to understand. If you haven't got a job, but you still need to get a property, what are some of the solutions? Well, obviously, you can rent. You can partner up with somebody and get into a short-term rental. You can try to get a down payment assistance program, either with the county that you live in or the CalHAFA program here in California. These are some of the solutions. Or, like a lot of millennials do, they move back home with their parents. And I wanted to talk to Daryl a little bit about that and say, hey, what do you what do you say about that in that solution? In terms of, I know it puts stress. The reason I bring it up is because we have a lot of visitors this summer with my daughter, and she's moved back home, and we have, I don't know, all her friends. And how do we turn this around to be able to put them into a home, even though we've got shrinking inventory and rising interest rates?
Well, I know a lot of people that are in that kind of shape. I've got a radio buddy that I just visited back at his parents' house the past couple of days. And, you know, it depends on what kind of business you're in, too, because the radio business, for example, can be a transient business, as you well know.
Yeah.
And, you know, to go to a bank or some sort of traditional lender and tell them to have, you know, 20 jobs in 20 years is normal for the particular industry that you're in is not something that a lot of traditional lenders like to see.
No, exactly. And I think in the acting world and any kind of entertainment, certainly there's a lot of, in the radio world, it's changed quite a bit, right? I mean, obviously over the last 20 years, we've gone from a very steady employment to sketchy. I mean,
yeah, catch as catch can.
Yes, exactly right. And I think even though you may find successful disc jockeys in certain markets, certainly in the back end, a lot of it is automated.
But you also have, you know, like stand-up comics, and you have people that work piecework in the behind the scenes, camera operators, and you know, people that do high-end photography in the business, and they move around a lot.
Yeah, I think that
project to project.
Right, and these type of borrowers, these type of people who need housing, who are looking for a solution, unfortunately in this market is very difficult because with the rates the way they are rising and with the inventory shrinking, there just isn't a $250,000 condo that you can get into or a $300,000 home that you can get into with very low down payment and very low payments, which is all of these professions need. And by the way, you got to prove that you can pay for the next 30 years.
Yeah, I left my parents' house at 18 and didn't look back. But
right,
I mean,
of course.
This guy I visited last week, he's 37, and he's back at home.
Yes, I know anybody in the listening audience who's listening to this knows that if you have that situation, yeah, I love my family and I love my children and I love those people that I can help out. It puts stress on you, it puts stress on the family. I think the solution has always been to add the extra unit. And I know in some counties they're allowing that a lot more easily than they used to in order to solve some of the housing problems.
I think LA County is one of those.
Yeah, I think that's right, exactly. All right, there are certain questions that we need answered for 2018. We're in the back half or the back 9 of 2018 right now. A couple of these questions, I just want you to give me your honest answer. One of the questions, there are 10 questions that this particular economist had. He had answers at the beginning of the year and now halfway through has a different answer, but I just wanted your opinion of some of them. One of them being, how much will the economy grow in 2018?
I think it's going to be flat.
Well, they have projections of, now I was reading today, that it's possible to grow by 4%. Now, of course, that depends on the industry. Is the stock market growing by that? What do they mean by GDP? Well, obviously, GDP is a number aggregated over a number of different industries, and it's basically all the goods and services in the country added up. How much do you spend this year versus last year? And it's possible to grow by 4%.
Well, I was going by whether you could go to a bank and open a checking account or savings account, what the interest return on that would be.
Well, does that be zero?
That's correct. It was 0 at the beginning of the year, and it's going to be 0 at the end of the year.
Actually, you know, it's funny because I do, too, look at these CD rates, they used to call them, as well as whether it's your passbook savings account. It used to be huge,
yeah,
right?
5, 10, somewhere, you know.
Yeah, exactly. Well, the CD rates are right now, I mean, if you go to some internet banks, you can get a CD rate at 2.5%. The passbook savings will never be above 0, which it is right now. But my own particular bank, which is a pretty good-sized regional bank, if I went in there and opened up a CD of $100,000 and agreed to have it there for 2 years, they would pay me 0.000 nothing. So I was like, well, why would anyone do that?
So when you say that the economy, whether it's expanding or growing, it may be, you know, on a GDP level, it could be changing, but on a personal level, it's flat.
Well, exactly. And I think what happens is when we get into the fact that people are spending more money, is that because they're making more money, or is it just because they feel good about the economy?
I mean, at the end of the year, maybe you get a performance bonus or something, but the COLA, cost of living increase,
right,
they're just not there.
Yeah.
You know, it's maybe 0.5% or 1%.
Okay, so let's look at question number 4 here. Will the core inflation rate rise in 2018? Meaning that, as you were saying, the things that are worth today, what are they going to be worth next year? Now, we've had core inflation at about 2%, and I think the target rate is 3%. Now, that includes wage inflation, right, where you're making more money. That's part of the core inflation rate. So if we get it around 3%, it means that people are making more money, but that's not what's happening.
It's not what's happening. I mean, in California, obviously, we have a minimum wage battle going on right now.
Right.
And whether that minimum wage is like $10 or $11 an hour or should be 15 or 16, and it's a huge jump. And even Disneyland has had an issue where the people that work there have tried to put it on the ballot in Anaheim for the city to vote for them to get a pay increase.
Now,
because the Magic Kingdom is not going to give it to them.
Well, you know, I don't know. Government getting involved in what people should and shouldn't make goes back to the base. What is minimum wage? Should it be a living wage, or should it be an entry-level wage? And I think I come down more on, you know, I want young kids in the workforce, so you're going to have to incentivize companies to hire them, but it's not necessarily, you know, McDonald's isn't the job that you're going to have when you're 50 years old, in my opinion. So if you're out there and you're thinking, yeah, I think that's true, I want my kids to get into the workplace, because if you're making 15, 16 bucks an hour at Walmart, you're not going anywhere. So where's the kid who's living on my couch where I started this whole thing, where are they going to get a job in an entry-level position unless they've spent, you know, hundreds of thousands of dollars in going into debt in order to be able to get a profession with which they can jump out the gate for $100,000, $150,000. Is that the way it's supposed to work?
Or the sole source entrepreneurs that want to start companies that can't afford to pay that kind of wage.
No, you can't. And again, I mean, so that means that you're basically working there for yourself. You're hiring an employee, and that employee really has you over barrel because you really need them if you're going to train them into the industry. I go through this a lot at my own company, whereby you have people, you train them really well, you have to pay them more, else they're going to walk out the door. But at the same time, can you afford it at a startup level?
Yeah, there's a California law that says if someone's going to be an exempt employee that's going to manage other people, they have to make twice the minimum wage.
What is that? $60,000 a year, isn't it?
Yeah,
Isn't minimum wage 15 bucks an hour, 40-hour a week? Isn't that 30,000 a year?
It's not 15 quite yet, but it's
pretty soon.
Probably 12,
2020,
oh, it will be.
22?
Yeah, there's a date that it'll be 15.
Okay, we'll get to one more question.
So that's 30,000.
30,000 a year is 15 at 40 hours a week. Yeah. I mean, so that's
2080 times 15. $30 an hour. So
yeah, that's 60,000 a year.
60,
I mean,
62.
that's, you know, that's a big number for a lot of people. Yeah. I mean,
for anybody.
Yeah, for anybody. Exactly right. Okay, question number 7. How much will residential investment increase? Oh, we've got 1 minute. We're talking about 1 point.
Residential investment?
Yeah, basically what we're talking about is, are we going to be building more houses?
Well, according to one of our callers, Tomas, they're going to build a hell of a lot of houses.
Can't be
500,000 houses. Yeah, I was playing Monopoly in my head.
500,000, maybe 50,000.
Yeah, maybe. Just, yeah, he's got a digit missing.
Yeah, exactly.
Somewhere.
I think 50,000 is a
still
huge
a lot.
number.
Yeah,
you know, I mean, it would really relieve a lot of the housing issues here in the Los Angeles, San Bernardino, Riverside Ventura, obviously the Inyo counties, Orange County. 50,000 houses is a big number.
Yeah, it sure is.
Okay, anyway, thanks, Darrell, for jumping in.
My pleasure.
I'm Jeff Barton, your voice in the mortgage industry, and thanks for tuning in. We'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.